Hi folks, and welcome to Module 4.2, where we're going to talk about debits and credits. An important element of debits and credits is just to understand the terms themselves. When we talk about debits, the only thing we're really talking about is the left side of a transaction. And when we talk about credits, we're going to be looking at the right-hand side of a transaction. So this is what we call a T account, and again, this will sort of create the form of our ledgers that we'll use in our course. So for every account, whether it be cash, accounts receivable, accounts payable, dividends, we set up a T account like this that's going to separate our transactions on either the left-hand side in the debit or right-hand side as a credit. So again, when we talk about debit and credit balances, what we're really looking at is either it's on the left-hand side or the right-hand side of our transaction or our account. And at the end of transactions, we're also going to add up our debits and add up our credits to figure out whether we have a debit or credit balance in the account overall. So again, as we go through the accounting cycle, as we have a number of transactions, those transactions are analyzed and they'll either be placed on the debit side or the credit side of an account. At the end of the day, once we add up all of the debits and credits, we're going to follow a rule that says which side is bigger, by how much, and keep the side of the winner. So if our debits add up to a bigger value than our credits, then our account will have an overall debit balance for the difference. Similarly, if our credits are a greater sum than our debits, then we'll have a credit balance for the sum of the difference. It's also important to understand that each of our different account categories has what we call a normal balance. So it means that at the end of the day, when we've done all of our transactions, we should expect that all of our assets would have a debit balance. We should expect that our liabilities would have a credit balance, and typically our shareholders' equity accounts would have a credit balance as well. Now it's important to sort of understand these different transactions and understand what we do for different types of accounts. And to be honest, in a lot of cases, this comes down to memorization. So take a look at these different charts, take a look at your textbook, and try to really understand. There's a number of different ways that this is sort of presented, and so find the one that makes the most sense to you and really study it hard. So what we say is that our normal balances, or the balance that these accounts usually hold, that's typically the side that increases the value of those accounts. So for example, if we were to increase the value of our assets, receive cash, buy a new truck or piece of equipment or a new property, anytime we increase our assets, we're going to increase it on the left-hand side or as a debit. Okay, if our assets decrease, so we pay out cash, we sell some inventory, or we receive an accounts receivable, a customer pays us back, that means that we don't have that asset on our books anymore, and we decrease it by a credit. Okay, and again, we typically have a positive value in our assets, and we have a debit side as our normal balance. Similarly, for our liabilities, just think of this as the opposite. When we take on a new liability, we have a credit balance. So we credit our liability. So our liability goes up, we owe more money. And if we pay off a liability, we'll debit that liability to decrease the value. Very similarly for shareholders' equity. What I'd like to show you now is another way to look at this. If we think about our accounting equation, think about our accounting equation, assets equals liabilities plus shareholders' equity. If we think about our shareholders' equity as our common stock plus our retained earnings, plus our revenues minus our expenses minus our dividends. So this is our accounting equation, and if we look at how this sort of looks, we can sort of place this on an account that looks like this. And so you'll see that our assets are on the left-hand side of this equation. And so we increase by a debit. Our liabilities are on the right-hand side, and so these increase by a credit. If we think about our share capital, again, that's going to increase by a credit. If we think about our revenues, that's going to increase by a credit. Now there's two accounts on the right-hand side of our equation that are a little bit confusing. They just like to throw a little trick into us. So if we take a look at our expenses and dividends, what I'd like you to notice is that these values are subtracted from our shareholders' equity. So we have a negative expenses and negative dividends. So if you think about it in the same sort of viewpoint, if on the right-hand side we increase by a credit, if we increase our expenses, we're really subtracting more off of our shareholders' equity because we have a negative in front of it. And so when we think about our expenses, they increase by a debit, and the same thing for our dividends. They increase by a debit as well. And we think about that, if we increase our expenses, we're subtracting more off of our shareholders' equity, and so in fact our overall shareholders' equity is going down, and when that goes down, we would be decreasing by a debit. Okay? And so a little bit conceptually challenging to think about expenses and dividends. They are a shareholders' equity account, but we have to think about how it works as a whole. If we think about our shareholders' equity as a whole, our shareholders' equity increases by a debit or by a credit and decreases by a debit. So if we think about what happens when our expenses increase, we have a higher expense that's coming off our shareholders' equity, and so our overall shareholders' equity is in fact decreasing, and therefore we would indicate an increase in expenses by a debit. Okay? Same thing for dividends. An increase in dividends decreases our shareholders' equity and is therefore recorded as a debit. Okay. So again, just to sort of reiterate some of those items, when we look at the different elements of our shareholders' equity account, again, when we issue shares, our shareholders' equity is increasing, and so we credit that increase. And so our common shares, our shareholders' equity goes up, common shares going up, be a credit balance. Again, when we reinvest earnings, our shareholders' equity goes up. And so again, shareholders' equity going up is indicated by a credit, and so an increase in retained earnings, which brings our shareholders' equity up, is also a credit increase. When we bring in additional revenues, again, revenues go into our retained earnings, and so as our revenues go up, our shareholders' equity goes up, and so both are indicated by a credit for increases. And as we just explained, when we have expenses, they come off of our shareholders' equity, and so our shareholders' equity goes down when our expenses go higher, and so we'll debit for increases in expenses. And quite similarly, when we pay out dividends, our overall shareholders' equity goes down, which is indicated by a debit. And so when dividends go up, we'll increase them via a debit. All right, and here's just another viewpoint to sort of look at that, those different increases and decreases. Again, it's important for us to understand the different types of accounts. When the values go up, whether we need to debit or credit them, and typically the side that increases an account is the normal balance. So for each of these accounts, the side that increases the account is the normal balance of that account. Okay, let's do a quick exercise here just to see that we understand. So we're going to look at a couple of different types of transactions. We're only going to look at one side of the transactions, and we want to understand the type of account we're dealing with, whether it's going up or going down, and whether we're going to use a debit or a credit. So a company receives cash. So cash is an asset, and if we're receiving cash, that asset is going to be going up. And if we think back again to our normal balances, our debits and credits, cash is an asset. When an asset goes up, we debit it on the left-hand side. Okay. Now we have a customer who buys a service. So this is a revenue. Someone has purchased something from us. So, and we have an increase in our revenues. And we recall that an increase to our revenues is equal to a credit on the right-hand side. Okay, a company pays an expense. So we have an expense that's come up. Our overall expenses have increased. We spent more on expenses, and an increase in expenses is illustrated as a debit. Okay, company pays a dividend. So again, our dividend account is going to go up. So we have a dividend account. We have an increase. And that's shown as a debit. The company owes a supplier. So we owe someone money, that we know that that's a liability. We owe more money, and so our liabilities are going up. And again, an increase in a liability is indicated as a credit. Okay, so this is a fundamental concept that takes some time to work through. There are some self-assessment activities and additional activities that we'll go through in our tutorial session as well to ensure that we understand this concept. Thanks so much, and have a great day.